The collapse in the oil price over the past few months has been incredible. In mid-June, the price of West Texas crude in New York was $107 a barrel. This morning, it closed at just above 74 in New York, a drop of 30%. It can only be called a reverse oil shock and potentially transforms the world economy. Why has it happened? Because demand is weak, especially from China, and America and Libya are increasing production a lot, and there's not much confidence that either of those things is going to change in a hurry. And it's not just the benchmark New York prices that are falling either. North Sea Brent and Asian Tapas are also coming down. For motorists and businesses that use a lot of oil, like airlines, it's wonderful news. But for countries that export the stuff, it's terrible. Here's a list of a few exporters with the price they need to balance their budgets. Libya and Venezuela are in deep trouble. Iran, Russia, Saudi Arabia and Mexico are all underwater. And in fact, there are only 3 members of OPEC that can balance their budgets with the price where it is: Qatar, UAE and Kuwait. And that's why OPEC is meeting tonight to cut production to get the price up. The trouble is that Libya and Russia in particular simply can't afford to. The Russian share market dropped 2% last night in response to the drop in the oil price, and most other global markets were fairly quiet. Investors aren't sure whether the falling oil price is good or bad. The answer, of course, is that it's both. And to demonstrate the good, Qantas shares jumped nearly 5% today as part of a general advance by the local share market, mainly led by banks and financials. Medibank Private slipped back to $2.10 on day 2. And the Australian dollar is down to a 5-year low tonight of around 85.5 US cents. And that's finance.